This information is designed to provide accurate and authoritative information with regard to the subject matter covered. It is offered with the understanding that the presenters are not engaged in rendering legal, accounting, or other professional services. If legal advice or other expert advice is required, the services of a competent professional should be sought.
Well, good evening and welcome, everyone. My name is James Orr, and tonight we got a really exciting presentation going on. This presentation is about joint venturing between active real estate entrepreneurs who are out there in the marketplace finding great real estate properties and real estate investors who are looking to take a more passive role in their real estate investing. Maybe they have a down payment and maybe they're willing to go get a loan, but they don't really have the time to manage the properties or to go out there and find the buyers and to do all the work that's required in order to get the properties done. But they're ready to do it in a more passive type of role. So we're going to talk about that tonight. This is primarily a presentation done at the bequest of a few of my real estate investor clients who are actively out there in the marketplace finding deals, and they don't have the resources to do all the deals that they're finding themselves, and so they're looking for ways in order to go out there and find additional people that want to do joint ventures and come together and do some partnerships. So this is kind of an overview as to how that whole process works. So we're going to go through an example tonight on this particular webinar on how to do it. Let's get started. So who is this presentation for? There's really two different groups of people that are going to come together and do these transactions. In some very rare cases, the person that wants to do these types of transactions will handle both roles. They'll be both the active investor and they'll also use the money side as well. But for the sake of this presentation, I'm really separating the two out. Real estate entrepreneurs, they are the active participants in the transaction. Real estate investors, they are investing money in the transaction. Entrepreneurs, they have a very active role. Investors have a very passive role. The real estate entrepreneurs are getting a return on the work that they're performing in the form of profits. And the real estate investors are putting up money, usually a down payment, and getting a loan, and they're getting a return on that money from the money that they invested in the form of profits as well. The real estate entrepreneurs, they're going to be finding the deals, they're going to be finding the buyers, they're going to find and manage the dream team, the contractors, the property management company in some cases that's going to handle the property itself, and they'll oversee and manage the entire investment. They are the active people that are going and making sure the investment's working the way it's supposed to. The real estate investors, very passive. They're going to put up the money, they're going to provide the down payment, they're going to provide the cash reserves that are going to be needed in case you have a vacancy or some repairs that are not quite paid out of cash flow, and they're going to get the loan on the property. So those are the two different roles, real estate entrepreneurs and real estate investors, and depending on which one you are, you'll kind of get some different things out of this presentation. So for this particular example, and I have to kind of just arbitrarily pick a starting point in order to go over an example. If you have a particular property you want me to go over with you, I'd be happy to do that. I'm a real estate broker here in Fort Collins, Colorado. But if you have a particular example you want me to go over, that's great. Let's sit down and do it if you're a client. If you're not, this is a really good overview of the entire process. So in this particular case, we're going to use a $200,000 property, very typical here in Fort Collins, Loveland, Windsor, Longmont, Boulder even. Well, Boulder's a little bit higher, but that kind of northern Colorado marketplace that's very typical. So we'll use that as an example. Your numbers are going to vary a little bit from area to area on property to property. The numbers I'm going to go over are not guaranteed. I mean, if I name a return that you're getting, realize I'm using this only as an example of what it might look like, and that you're not automatically going to get this exact percent return. It may be better, maybe worse. And so it really depends on the specific property. We'll go over any other assumptions I'm making as I go through the presentation, but I just want to let you know that there's no guaranteed return. Returns can vary. You could do much better. You could do much worse than what we're going to be talking about tonight on this presentation. So this is a visual, big picture overview of the process, and you'll notice it's a repeating circle because you can do this process over and over again. In fact, I recommend that you do it over and over again. Once you find a great deal and you've kind of got it occupied and you've got your tenant buyer in place, we're going to be talking about doing another one and another one. And so there's some different ways to kind of do these things in kind of groups. However, this is the overview of the entire process. So the first step in the process is going to be finding the deals. Next step is going to be closing on the properties. Once you find it, you got to go get the financing, put up the down payment, and close on it. Then once you've got it and you own it, you're going to occupy it. Usually in this case, this particular example, we're talking about tenant buyers, someone who's going to rent the property for a period of time before they actually go out and get their own loan and buy the property from you. And I'll talk a little bit about some of the benefits of doing that and why we do it that way during this presentation. But pretty much we're going to close on the property, then we're going to occupy the property. Then once the property is occupied with the tenant buyer, we're going to then manage the property, oversee it until the buyer actually goes and closes on the property with their own loan and cashes you out, which is the sell phase. So at that point, you're actually selling the property, and then of course you repeat the process over and over again and continue with it. So that is the overview of what we're going to be going over tonight. All right, so there's a lot of information here on this slide, and I don't need you to go and read all the details. In fact, the details are not current, but this is a partial list of some of the tools that I provide to my clients, the real estate entrepreneurs in most cases that are looking for properties in the local real estate market. Fort Collins, Loveland, Windsor, Longmont, and Greeley is what we're going to be adding on here shortly. But really what I wanted to point out is this one column, and that column is Profit B. This is a list of all the properties I've analyzed. Every morning I get up, I analyze all the newest listings and all the ones that had price changes in our local multiple listing service in order to find the ones that are the best deals. And I contact my clients and say, look, this one looks really interesting. It's listed for $50,000 below or $30,000 below, or in some cases $100,000 below what the assessor, the public record assessed value is from the tax guy here locally, thinks that the property's worth. So if the assessor thinks the property is worth $220,000 and someone is trying to sell that property for $170,000, we'll realize there's a big spread between what the person that is selling the property thinks it's worth, or that is trying to sell it for whatever reason. Maybe it needs repairs, maybe there's a motivational reason for them selling it at a discount. But I look at that among other reasons, like doing full market analysis on properties. But one of the main indicators I use is the difference between assessed value and what the person is selling the property for. Profit B is that difference. So in this case, the first property on the list, the very top one, is being sold for $220,000, but it's assessed for $115,000 more than that, so $335,000. So it's offered at a significant discount. Now, there may be some major issues going on with that property. However, what we're going to use for the sake of our example is a 10% discount. And I want to let you know that I think that's a good number to shoot for. Sometimes you can get properties that are good rental properties, good rent-to-own properties where you can get a slightly bigger discount. But I think if you're getting at least a 10% discount, these numbers are going to be pretty accurate as far as the example goes. So, and usually these properties are in the top 1% of the market. You don't know how many properties I needed to go through in order to find the ones that had these types of profit spreads on them. We're talking about hundreds and hundreds of properties in order to find the very few that are actually discounted and would be good properties to buy and do a rent-to-own with. So we're usually talking about the best 1% of the properties on the market, and that usually means that we're going to be buying with at least a 10% discount, sometimes a little bit more. Sometimes when you have a really good property and you got a really good tenant buyer lined up and they're ready to go and they kind of have a preference for a certain property, you might be willing to do one with a little bit less. We'll talk about those examples probably one-on-one, not in this presentation. But this is kind of a list to show you the different profit, and so I do this analysis every day for my clients, mostly the real estate entrepreneurs trying to find the deals in our local marketplace. So you're going to be buying these at a 10% discount. It's an important assumption that we're talking about for this model. So once you find the deal, remember we had our little kind of overview of what's going on. You find the deal, then you close on the property. Now, when you're closing on the property, the real estate investor, remember, is the more passive person. They're going to be usually putting up the down payment and going out and getting the new loan on the property. So in this case, the real estate investor gets a new loan and provides a down payment for the property purchased for $200,000. Now, what's a $200,000 property worth? Remember, we just said we're going to get a 10% discount, so it's worth about $220,000. Give or take. So you're buying it for $200,000, it's got to be worth at least $220,000. 25% down, and remember we're buying it for $200,000, so it's 25% of the purchase price. That's what they're going to use when they're trying to qualify for the loan. So a $200,000 purchase price, 25% down, which is usually about what you need in order to get an investor loan in our current financial market. That's going to be about $50,000 down. So as a real estate investor, in order to buy a $200,000 property, you'll need $50,000 down. The estimated closing costs are going to be about $6,000. In some cases, we can get the seller to pay part or all of those, but let's go ahead and plan on paying all of them ourselves. For the sake of this example, it's going to make our numbers a little bit more conservative, but let's assume you got $50,000 down plus an additional $6,000 in closing costs, costs in order to get the loan and the title company insurance and things like that. And I can go through a list of all those in detail with you at another time, but just for now, to realize it's $6,000 in closing costs. And then in addition to that, the $50,000 down and the $6,000 closing costs, we're going to also ask that you put up $10,000 in cash reserves for the sake of this example. And what that's really going to cover is any vacancies you have where you don't have income coming in, you need kind of a buffer, any unexpected repairs you may need on the property. We're going to talk about the tenant buyer doing repairs, but what if you have a repair that the tenant buyer can't afford? Sometimes you need to front that repair money, maybe adjust the price on the back end of what the tenant buyer is going to be buying the property for, but realize that this $10,000, you do need to have some type of buffer. I think it's not a prudent business strategy to go into this without some additional cash reserves set aside in a bank account, maybe held by the LLC if you're going to set up an LLC in order to do these, that can be used in order to fund emergencies and vacancies and unexpected expenses associated with the investment. So the total, if you add up the down payment, which is $50,000, the estimated closing costs, which are $6,000, and the estimated cash reserves for doing the property of $10,000, is going to be $66,000. So that's what we're going to use as our baseline number for doing this particular investment. We're going to say the real estate investor put up $66,000, the real estate entrepreneur went and found the property, and now they're going to use that property and find a tenant buyer, and they're going to go through the process of finding a tenant buyer to go and buy the property from them. So those calculations we're going to do later where we estimate your return on investment. $66,000 is the initial investment we're calculating. So once we have the property, the real estate investor has gone out, gotten the loan, they've closed on the property, and it's now owned by the joint venture, whatever it is you're holding it in, an LLC or corporation, whatever your tax advisor recommends. Then what you're going to do is the real estate entrepreneur will go out and find a buyer who will rent the property for a period of time before they get a new loan and buy the property. So realize what we're doing. We're not going to immediately turn around and try to sell the property. What we're going to be doing is selling the property to someone who wants to rent it out for a year or 2 years or 3 years before they go get a new loan, and then eventually their loan cashes you out of the property, and they end up buying the property that way. Why are we doing that? Why are we catering to buyers that are having a challenge getting a loan now or need some time in order to get a loan? Well, one of the reasons is that's a very underserved market, and they're willing to usually pay a premium on the price of the property in order to be able to buy that way. So maybe it's somebody who just transferred into town from an out of area and they don't have enough job history in order to get a loan. Maybe it's somebody who had a foreclosure 3 years ago because they financed 125% of their purchase price and the market actually went down 25%. Maybe they're from Arizona or from Las Vegas or Southern California or Southern Florida, and they were upset on their mortgage and they strategically defaulted and said, yeah, I just can't afford to pay this. My property is worth half of what it used to be, and I owe $200,000 on a $100,000 house. I'm just going to walk away. And they need some time in order to do that. It's not that they can't afford the property. They want to be a homeowner. Just the market turned against them, and they want to now buy a property, and they need some time. Rather than having them move twice or rent it for a year or two, and then ultimately go and buy a property later on, you could actually find them the property they want to buy now and structure an arrangement, a rent-to-own agreement where they're going to rent the property and eventually buy it from you a year or 2 or 3 years down the road. So in the case of someone doing that, usually what they do is they put up a small non-refundable purchase deposit that says, look, I'm serious. I want to buy this property. And so I'm going to give you a non-refundable purchase deposit that says I'm really serious about buying it. Now, it varies all the time from buyer to buyer. Some buyers come in 10% down, some buyers come in 20% down, some buyers come in, 1% down or 2% down. But in this particular case, we are going to assume that they're coming in with 3% of the purchase price as a non-refundable purchase deposit. Could be more, could be less. And in fact, it's up to you to decide whether or not the purchase deposit that they're coming with is enough. If they only come in, they only have 2%, you have every right to say, I don't feel comfortable putting you in this rent-to-own property with only 2% down. We're going to wait for another buyer, or can you come up with another 1% or whatever it is that makes you feel comfortable doing it. So 3% is what we're using as the non-refundable purchase deposit. The buyer typically pays the top of the market value range for the right to buy the property instead of just renting. So in most cases, if the property is worth $220, they're not going to be negotiating a discount. Remember, usually cash, the ability to go out there and get a brand new loan, is what gives you the largest negotiating power. Your ability to act quickly and a sign of strength in your finances allows you to go and buy the property. If you don't have that strength, then usually you're paying toward the top end or the very top of that particular price range on that property. So sometimes even buyers will pay a small premium above the market value when they are looking to buy a property on a rent-to-own. In this case, we're going to be talking about a top of the market range, maybe a very small premium when we set the price for what someone's going to buy the property on a rent-to-own. Let's take a look at some of those numbers here. So pricing the house for sale. Big picture. You're going to be buying the house at a discount for cash. In fact, it's actually with a new loan, but it looks a lot like cash because the seller is actually getting all cash. The bank is just providing it. And then you're going to sell at the top of the market with really flexible seller terms, in this case on a rent-to-own. So you're going to be flexible with your buyer coming in, but you're going to buy from a very strong position with cash, in this case a new loan, when you're going to go buy the property. So remember, we talked about the current fair market value of the property was $220,000. Remember, we purchased it for $200,000, but remember, we're going to be getting a 10% discount at least. And in this case, I used about 10%. $20,000 from a $220,000 property is about 10%. So basically, to make the math look a little bit better, I used $20,000 and $200,000. Even though it's not technically 10%, but it's very close. So $220,000 what it's worth, $20,000 discount, you're actually buying the property for $200,000. Then what we're going to do is we're going to turn around and we're going to sell the property to the tenant buyer on a rent-to-own for $224,900 a year from now. So the buyer goes in, they move in today, they pay their non-refundable purchase deposit, they start paying rent on the property, and rent looks an awful lot like what the payment would be. I'm going to show you how we calculate that in a second. But rent starts looking an awful lot like what the payment they would need to be able to make on the property if they were going to buy it. And then sometime during that year, ideally, they're going to go and get a new loan on the property and buy the property. If they don't do it in the first year, we may be willing to extend it for another year or even a third year, or in some rare cases, maybe even a fourth year. But we're giving them time to go out there, continue to rent the property, and then eventually go get a new loan and then cash you out and close out the investment transaction for you. So remember I said the property's worth $220. Is selling it for $4,900 more than probably the top of the market of what a normal cash buyer would be paying for property? Is it unreasonable to think that you can get $4,900 above what the top range of a cash type buyer would be able to get for the property? Is that reasonable? Well, let's take a look. Since 1996, Fort Collins has gone up in value on average 3.42% per year. That means that each year, property values in Fort Collins have gone up on average of 3.42. Some years it's been more, some years it's been less. But on average, over that time period, which is, 16 years? 17 years? Property values have gone up 3.42%. So, if Fort Collins continues to appreciate at 3.42%, and as an aside, nationwide, over the last 40 years, property values in the United States have gone up about 6%. So Fort Collins has been nice and slow and steady at 3.42. Okay? So it's not like an anomaly that Fort Collins has gone up in value that much. So if Fort Collins continues to appreciate at 3.42%, a $220,000 home, that's what we think our home is worth, would actually be worth, after 1 year, $227,524. That's more than our asking price of $224,900 by like $3,000. So in this case, just the appreciation, the tendency for home prices to go up in value over time, would make it so that the tenant buyer, the person that you're selling the property to on a rent-to-own, would be getting a little tiny bit of equity in the deal. Not much. I mean, they're still paying pretty much top dollar, but a little bit. You know, you're selling for $224,900, they're going to buy for $227,000. If it goes 2 years and you don't have a clause in your agreement with the buyer to have the price go up a little bit, and by the way, you can structure it that way. I mean, there's some advanced kind of things that I don't want to go into too deeply now, but you can actually have a clause in there that says, okay, you got a year in order to buy, but if you go more than a year, the price is going to go up a little bit. If you go more than 2 years, the price is going to go up a little bit more. And the rent's going to go up. Okay, so you can structure things like that in your agreement. We're not going to go into all the detail of that in this particular presentation, but definitely talk to me if you want to know more about that. If you're a client, we can sit down and go over that together. So in the first year, it goes from 220 to 227 and change. In the second year, it goes from 227 to 235 and change. And then after the second year, from second to the third year, it goes from 235 to 243. If it goes 4 years, and we're going to use this number later, if it goes 4 years, though, it's 251. So the property right now that we bought for 200, that's really worth like 220, 10% discount, will be worth 251,000 in about 4 years if the appreciation rate stays at about 3.42. Okay? So we'll remember that 251. We'll come back to it later, but I'll reference it later and I'll say, look, remember we talked about this? It was 251. All right, so once we kind of know these sort of numbers, the next step, the real estate entrepreneur, not the real estate investor. Real estate investor is the guy putting up the down payment and getting the new loan, but the real estate entrepreneur goes out there and they're going to find a tenant buyer. They're going to do marketing. Usually, takes about 60 days. Sometimes if you get really lucky, you can do it pretty quickly. Sometimes if the market's a little slow or you have a problem finding somebody that you feel comfortable with, qualified wise, you're looking at their application, you're looking at how much they have to put down, and you don't quite feel comfortable, maybe it takes a little bit longer than 60 days. But typically it's about 60 days in order to find the property and then put a tenant buyer in there if you're doing your marketing right. So if it's 3 weeks in after you bought the property, you don't have a tenant buyer, don't get nervous. It takes some time. Okay, so 60 days is about the typical time. Then if you assume, in this case, we've made an assumption that it's about $7,000 in non-refundable purchase deposit from the tenant buyer. That's a little bit more than 3%. It's 3.11% of the $224,900 that we're asking them to come up with. If they can't come up with $7,000, they're not qualified in order to buy this house. Right? Now you could set whatever number you want, but if you set $7,000, and you say, look, I want you to have $7,000 down payment invested into the deal, and they come to you at $5,000, it's up to you to decide, but in this particular example, we're saying it has to be $7,000. Okay? And then the remaining balance, if you apply that $7,000 toward the purchase, because it's a non-refundable purchase deposit, they're putting it up to say, look, I'm committed to buying this property. It's almost like earnest money. If they don't buy, and it's not your fault that they didn't buy, but they default on your agreement, then that earnest money is liquidated damages. You get to keep it as a non-refundable purchase deposit. Okay? So if they put up the $7,000 less than $224,900, which is the purchase price, is $217,900. We're going to use $217,900 to see what their cost of buying that property would be. So they're buying the property for $224,900, $7,000 down payment. They owe $217,900 if they were going to go get a loan and they had to get a loan for that amount. So in this case, they'd already give you $7,000 in cash. They would be able to go get financing for $217,900. Let's take a look at what the monthly income would be on our side, and then the monthly expenses for the tenant buyer on that particular transaction. So the monthly income and expenses. So what are your expenses? When you're buying the property, let's take a look at what your monthly costs are for owning the property. Well, you bought it for $200,000. You put 25% down, so you put $50,000 down. So you actually have a loan for $150,000. Bought it for $200,000, put $50,000 down. You still owe $150,000. So if you finance $150,000 over 30 years, we're getting a 30-year mortgage, and interest rates right now for owner occupants with good credit, 4%. Okay. For investors, you usually take a slight hit, but let's say 4.625 is a conservative number right now, and these numbers change every day. But 4.625 is conservative right now for figuring out what your monthly payment would be. Okay, and so if you had a $150,000 mortgage at 30 years at 4.625%, your monthly payment would be $771.21 per month. So a little less than $800, $771.21. Property insurance, the insurance you have on the property in case there's a fire or in case someone slips and falls or something like that, we're going to say it's about $80 a month on buying that property. I think that's conservatively high. Okay, so $80 a month. The taxes on a property that's worth about $220 will be about $120 per month. Realize, though, that we're going to be asking the tenant buyer, look, you're going to be buying this property, so we need to make sure that you can afford the payment if you were going to buy the property, plus the taxes, plus some insurance. Now, we're going to pay the insurance, we're going to pay the taxes, and we're going to pay the mortgage payment. However, we may also collect from the buyer what their payment would be like, and it's rent, and may also ask them for taxes, and their HOA if there's an HOA on that particular property. Okay, but in this case, we're saying taxes are about $120 a month, but really the tenant buyer is paying this. Okay, so there may be a true cost, and we need to cover it, but we're really going to try to collect it from the tenant buyer because they're really ultimately trying to own the property, and they need to be prepared to do that. Now, there's always this question, and I'm not sure if I should cover this now or not, but a property like this, might rent for $1,200, $1,300. How do you justify, or how do you get the tenant buyer to be willing to pay $1,300, $1,400, in some cases, $1,500 a month for the payment, taxes, insurance, and the HOA? Well, you're not just renting it to them. They need to be able to buy the property. If they cannot afford what the payments would be, plus the taxes, plus the HOA and the property, what they're really saying is, I cannot afford this property. Okay, and so you're not asking them to pay rent. You're telling them you're paying this amount of money that is part of the ownership process. Okay, and we want you to buy and get a new loan as quickly as possible, and you need to make sure that you can pay those payments. Okay, so if they can't afford it, they can't afford that house. So if they tell you, look, I can only afford $1,200 a month, well, this house isn't for you then. You may want to be looking at $150,000 houses or $160,000 houses, but this one's a $225,000 house. Okay, so your expenses, your mortgage payment $771, property insurance $80 per month, taxes $120 per month, HOA if there is one. Tenant buyers should be paying that as well, though. And then the buyer should handle most of the maintenance on the property. So you tell them you're going to be buying the property, you're responsible for the property, and that is part of our agreement that you're going to be doing it. Now, as an aside, a practical matter, if the roof goes bad on the property and the tenant buyer can't afford to fix the roof, who's paying for that? You, the investor, the entrepreneur. That's what that reserve cash is for. So if you have a vacancy and you need to make your $771 a month payment on the property, that's what that reserve money is for. If you have a repair that needs to be done, hot water heater goes out and the tenant buyer can't pay that, they can't pay the $1,000 to replace the hot water heater, well, guess what? That's what that reserve money is for. But then maybe you add it on to the price of the house. So maybe it was $224,900 and you had to replace a hot water heater and that cost $1,000. Now it's $225,900, and you having to talk with your buyer, your tenant buyer, about that and say, look, you normally you said you'd be buying this. The hot water heater went out, so I'm not sure what happened. It was working when we gave it to you. However, I'll tell you what, I'll pay for it now, but you're going to end up just adding it on to the price, and you have a discussion and you negotiate that. Okay, so those are the expenses. What about the income on the property? Well, they're going to still be buying the property for $224,900. They owe about $217,900 after we subtract out that $7,000 non-refundable purchase deposit. So they owe $217,900. If they were going to go to the bank, that's what they would need to come up with in order to finance the property. So if you do $217,900 over 30 years, and their interest rate on this particular property, and you're setting it, it's arbitrary by you, whatever is fair in the marketplace. But I don't think it's unreasonable to think it could be, 1%, 2% higher, maybe even a little bit higher than that, 3% higher than what current bank market rates are. Not unusual at all to have a premium for owner financing or short-term financing on a property where they're doing a rent-to-own. So $217,900 over 30 years, 6.5%, gives you payments of $1,377.28. Well, the payments you're charging, the income you're getting is $1,377. Your underlying expenses are $771. You can see there's a nice spread there. So you should have positive cash flow on this property. Now we're going to ask the buyer to pay the taxes and the HOA if applicable. I don't usually have the tenant buyer pay the insurance on the property. I make sure they get their own insurance to cover their own stuff, but usually I cover insurance. You can do whatever you want, though. It's up to you to kind of work this out the way you want to. There's lots of variations, and I'd be happy to discuss some variations with you one-on-one. But for the sake of this example, I'm asking them to pay taxes and HOA. And so the calculation I'm going to do in order to determine what your monthly positive cash flow is, I'm going to take that $1,377. I'm going to subtract off the $80 a month for property insurance, because that's a true expense, and the $771 that you're paying on your underlying mortgage, and what's left over is your gross positive cash flow. Because we're really not taking into account there's a vacancy and things like that. But really, you're going to get $526 if the tenant gives you a check for $1,377, and you got $80 going out for property insurance, and your underlying mortgage is $771. You have $526 per month left over. That's positive cash flow. Okay, so we're going to use that number in order to do some calculations now. So I guess before we do that, when will the property be sold? Property is going to be sold when the tenant buyer gets a new loan and actually closes on it. So could happen in the first year, but it's not likely. These things typically take a couple years. They can take 4 years or more. My personal philosophy is if somebody's willing to go and continue to pay rent on the property, they continue to work toward getting a new loan, I will give everyone an equal opportunity and every opportunity to go out there, take the time they need in order to get a new loan and buy the property. I will not kick someone out who's paying, in other words. I'd rather play win-win, have everyone succeed, and be able to buy the property. And if it takes another year or two, we may need to adjust the price, we may need to adjust the income on the property, the market rent, or the income that they're paying for the rent-to-own portion. But whatever it is that needs to happen in order to make them be able to continue to buy, I want to work with them. So if they opt not to buy, let's say they go for a year, you decide, okay, it didn't happen in the first year, let's renew it for another year, we'll give you another year to do it, and during that second year, let's say something happens where there was a couple and they split up. So they're no longer married or they're no longer together, and they decide, this house just really isn't for us. I don't need this big house because we're not together anymore, and she got kids and he got a couple kids, and they don't need the big house anymore. So maybe they need to say, well, we're just going to pass. You can keep our non-refundable purchase deposit, and we're going to go rent someplace else, or we're going to go buy something else, a house that's more appropriate for what we need to do. Happens all the time. Okay, so if that's the case and they do it, then maybe you need to go find a second tenant buyer. So you figure out what the new current market value of the property is. Most of the time it's going to be more. And then you're going to reprice it, you're going to find a new tenant buyer, and you're going to start the process over again. Then it may take another year or 2 or 3 in order to have that tenant buyer in order to cash you out. Now, if they fell out too, you may need to do a third time. But it's not bad when it happens, and I'll show you here an example. Sometimes it could be really good in order to do that. So each year that this happens, you collect more positive cash flow, you pay down on your underlying loan, and it gives you a bigger profit spread. So the longer it takes, in some ways, it's better. Okay? And there's conflicting forces going on about whether it's better to do this really quick or if it's better to do it over a long period of time. Because if you buy the property, I won't get into the math now because we haven't gone over the math yet. But there's some conflicting forces over whether you should do it really, really fast and get a really high, big chunk of cash over a very short period of time gives you a really high annualized rate of return. But if you do it over a longer period of time, you still have things working towards you, like the property values going up in value and your loan being paid down, which improves your return, but it's over a longer period of time. Okay, so they're kind of opposing forces. All right. If the property is sold in 1 year, let's walk through what has just happened. Okay, so you got, and I'm assuming it happened at the very last month of the year. It took 12 months, and in the 12th month, they actually went and got a loan, cashed you out, and they closed on the property. So what happened? You had 12 months of positive cash flow. Well, remember, positive cash flow was $526 a month, and that happened for 12 months. So your total positive cash flow for that period of time was a net $6,312. Okay? So you had $6,312 in positive cash flow. Then you had a sale. Remember, if it happened in the first year, you set your price at $224,900. What did you buy the property for? You bought it for $200,000. So $224,900 minus the $200,000 that you bought it for gives you a profit of $24,900. Now you paid down a little tiny bit of debt on your loan. You had a $150,000 loan that you had yourself, and you paid down 0.9% of that in the first year, or about $1,350. Relatively small amount. So the gross profit is $32,562. That is the sum of $6,312 from the cash flow, $24,900 from the net proceeds from the sale, and a debt pay down of $1,350. Okay? And the real estate investor, the active participant, got a return on investment. I'm sorry, the real estate investor, the one that put up the down payment and got the loan, got a return on investment on an investment of $66,000. So they got their $66,000 back, and then they got a return of $16,281 on that initial investment. And this was a passive investment for them, because the real estate entrepreneurs, their side of the agreement was they did all the work. Okay, so for $16,281, a real estate investor made 24.67% per year, because it was a 24.67% return, and it happened over the course of a year. So it's 24.67% per year. Now, the real estate entrepreneur, the active participant, the one that did all the work, got $16,281 for the work that they performed. It was a return on the work that they did. So they labored, they found the tenant buyer, they found the deal, worked with the agent, find the deal. They actually found the tenant buyer, got the tenant buyer in there, managed the process, and then at the end, when it actually sold and they coordinated all that, at the end, $16,281. Okay, so kind of a nice split. One did all the work, was active. The other one was very passive, put up the money, and got the loan. And he split them. Okay, that's year one. Okay, let's take a look at year two. In year two, if we go full 24 months, you had 24 months of positive cash flow. $526 a month times 24 months gives you $12,624. You had net proceeds from the sale. In this particular example, trying to be a little conservative and say you did not raise the price. So you were a nice guy and you said, all right, tenant buyer, you didn't buy in the first year. We're going to keep the price the same at $224,900. And as long as you buy it in this next second year, we're going to keep the price at $224,900. So they did $224,900 minus the $200,000 that you paid for the property, gave you a profit from the sale of $24,900. You also paid down debt on your underlying mortgage for 2 years now. In the first year, it's $1,350. In the second year, it's actually $1,500. So the total amount that you paid down on the debt on the property is about $2,850, $2,850. So the gross profit from cash flow, proceeds from the sale, and debt pay down is about $40,374. You split that in half. The real estate investor, the person who put the down payment and got the loan, they get half of that. They get their initial investment back, but they also get half of it. And the real estate entrepreneur who did all the work gets half of it. So $20,187 for each. Okay? The real estate entrepreneur who did the work, that was their pay for doing 2 years worth of work, finding the deal, finding the tenant buyer, managing the property, working with the tenant buyer to get qualified and get a loan, closing on the transaction, and overseeing that whole process. And then the real estate investor who put up the $66,000 as a down payment. Well, $50,000 down, $6,000 in closing costs, and then $10,000 in kind of just a buffer for expenses, unexpected expenses. But a $66,000 investment, they made $20,187 over 2 years on that investment, which works out to be about 15.29% per year. So about 30% overall, but since it was over 2 years, 15.29. Okay? Let's take a look at what it does in year 3. All right, so if it happened in year 3, you had 36 months of positive cash flow, $526 a month times 36 months gives you about $18,936 in cash flow. Now, in this case, we also assume that you're still selling it for $224,900. So you did not increase the price from your tenant buyer. You let them do $224,900 even into the third year. So $224,900 minus $200,000 profit gives you $24,900 profit on the sale. Then you had your debt pay down for the first 3 years. 0.9% the first year, 1% in the second year, and 1.1% in the third year is approximately what you pay down in debt on a loan. That was on a $150,000 loan. So in the first year is about $1,350, second year is about $1,500, and in the third year is about $1,650. So total, you pay down about $4,500 in debt on that $150,000 loan that you had. So the total gross profit you had from cash flow, net proceeds from the sale, and the debt pay down was about $48,336. Again, we split it in half. The real estate investor, the money side of the transaction, to put up the down payment, the closing costs, and the repairs on the property, which was $66,000. They got $24,168 for doing that, which if you figure out the return on investment, $24,168 divided by 66, divided again by 3 because it was over 3 years, gives you a 12.21% per year return on the investment. The real estate entrepreneur who went out there, found the deal, found the tenant buyer, managed the whole process, helped them get qualified, and helped them close on the loan, they earned over a 3-year period $24,000 for the work that they performed, or about $8,000 a year. Okay? That's if it was sold in year 3. Now I'm going to throw you a curveball. What happens if your tenant buyer goes for 3 years and then they get a divorce or they get transferred for a job or they decide, we just won the lotto, we're going to buy a $5 million house instead of a $200,000 house, and we're no longer interested. You can keep all the money you paid in for rent because you don't get that back. Non-refundable purchase deposit, you can keep all that. And now let's look at what happens if we get another tenant buyer, a different one, and we do year 4. So if after 3 years the initial buyer does not buy and you find a new buyer that wants to buy at the end of the 4th year, their first, because it's a second buyer doing the first year, but basically it's your 4th, the property is worth $251,674 at the end of year 4 if appreciation remains at 3.42%. This is that number I mentioned before. Remember I was telling you property values have been going up in Fort Collins 3.42% a year. And so I said at the end of the first year, at the end of the second year, at the end of the third year, at the end of the 4th year, it's worth $251. Well, guess what? This is the 4th year. So now the property is really worth $251. In fact, in the last 3 years, we've been using that $224,900, which I was trying to tell you is conservative because we never raised the price on the tenant buyer. So those examples are pretty conservative just from that. But if in this case, at the end of the 4th year, the property is worth $251, what if you sold it instead of $224,900? Now that it's worth $250, you set your price for $249,900. What does that look like? Okay, so let's take a look at first buyer decides not to buy after 3 years. You go find a new tenant buyer, you get them in there, and at the end of that year, the first year, the 4th year for you, what happens? They buy. Let's take a look at what those income and expense numbers look like. Your expenses are largely unchanged. Okay, your mortgage payment, you still got a $150,000 mortgage. That hasn't changed because you're paying the same amount over 30 years. At 4.625% is $771 per month. No change there. Property insurance, $80 per month is what we said at the initial time. But, expenses go up over time. Insurance rates go up over time. And so 4 years from now, you would expect your property insurance to have increased. Maybe 10%. No one knows, but let's guess and say 10% higher. So now instead of $80 per month, it's $88 a month. We'll use that in our example. Okay. Now the taxes, we used $120 per month. Taxes are probably going up, right? But remember, we're passing that expense on to the tenant buyer. So even if it's now at 10% higher, the tenant buyer is paying that. So it's kind of a wipe. It doesn't really get included in this particular calculation. And of course, if there's an HOA, the tenant buyer is paying that as well. And of course, the buyer should be handling most of the maintenance on the property, but you do have a cash reserve set aside for that as well. Okay, the income on the property has changed though, because if they're buying it for $249 and they put down, $7,000 and change on the property, then they're really borrowing $242 over a 30-year period at 6.5%. Their payment now is $1,532 per month because the price is higher. We're not doing a $225,000 property anymore. We're doing a $250,000 property. So the payment goes from whatever it was, I forget now, but it goes up to $1,532. And of course, as I mentioned, buyer's going to pay all the taxes and the HOA according to what you work out. But it's negotiable, but usually that's how I would set it up. Okay, so the monthly positive cash flow is at $1,532 minus, we're using $88 for property insurance, because usually I'd pay that, minus the $771 that you have on your mortgage payment, and it gives you an improved cash flow now of $673 per month. Before it was $500 and change. Now it's $6 something. Okay, so $673 per month. So what happens if you sold it in year 4 now? You have 48 months of positive cash flow, but it's at 2 different rates. The first 3 years were at $526 per month for 36 months, so you had $18,936 from that, and then you had 1 year at the new higher positive cash flow rate of $673, so now you have $8,076 from that. So total $27,000 and change, $27,012. That's for 4 years worth of positive cash flow. Now you have the net proceeds from your sale. In the past, we've been using $224,900. Now we're using $249,900. So your profit from the sale has gone up from $25,000 approximately to about $50,000, $49,900. The debt pay down over the first 4 years, a total, I won't go break it down for you, but total amount, $6,300 for 4 years. So the gross profit overall from the 4 years of positive cash flow, the net proceeds from the sale, and the net pay down you have on the loan is about $83,212. Split that in half. The real estate investor gets half of that. The real estate entrepreneur gets the other half. The real estate investor, $41,606. They have their initial investment of $66,000. So over 4 years, that works out to be about a 15.76% per year return on their money. The real estate entrepreneur got paid $41,606 for all the work they did, about $10,000, a little bit more than $10,000 per year for the work that they did. Finding the tenant buyer, managing the property, finding the deal, working with them in order to get them qualified, in order to get a loan, and then closing out the transaction. Okay? So it's a good deal overall for both parties. So here's a return on investment summary. If the first buyer closes in year 1, 24.67. Year 2, 15.29. Year 3, 12.21. If buyer 2 closes at the new price in year 4, 15.76. One of the reasons I broke it down like this is I want you to realize that losing your buyer is not a big deal, because you're going to readjust the price, you're going to get your new buyer in there, and then you kind of get to restabilize things. And you'll notice in year 1, 2, and 3, the annualized rate of return. And by the way, these numbers are for the real estate investor. The real estate entrepreneur is doing all the work. They don't have any money invested. They've got time and the work, and so their pay is basically the profit from the deal. Okay, but if you have a $66,000 investment, this is the return on that investment. And as an aside, for those that are kind of really following along, you're paying attention, advanced investors, realize you're getting part of that $66,000 back as part of cash flow, because your cash flow is coming out of the deal. So it's really a declining investment amount, if that makes sense. Okay. So in this case, buyer 1, the returns on it are going down over years. Why is that happening? Well, part of the reason why it's happening is we're not raising the price of the property, Remember, we said that was 224.9 for all 3 years, and if you had actually raised it a little bit, it actually wouldn't be exactly equal on each year because there's different numbers going into each one, but it wouldn't be nearly the decline you're seeing here. Okay. And then, of course, if you have to replace the tenant buyer, you get to do that price change, and you get a nice bump in your return again. Okay, so that's the investment summary. Of course, the nice thing about this for real estate investors, people that are looking for the down payment, is you can do this type of investment with retirement funds, like an IRA or 401k. Go get a self-directed IRA. They have $50,000 or $66,000 in this case, and you can go ahead and do these transactions. You fund a new LLC, and there are self-directed IRA companies that will help you set that up. I'm not an expert at that. That's what they do, and they can coordinate that with you. So that's pretty much it. Let's review the process again. Find the deal. Real estate entrepreneur goes out there and finds a deal. Usually it's with a real estate broker like me who's finding great deals in the local marketplace. But once they find that deal, then you fund it and you close on the deal. That's when the real estate investor comes in, puts their down payment, funds the kind of repair account, and pays the closing costs. And then you close on the property. You then own the property. Usually as some type of entity, but it's up to you to structure that however you want to. Get the help from an attorney. And then the real estate entrepreneur goes to work finding a tenant buyer for the property, and they occupy it. Then they manage the investment, work with them to make sure they get qualified, and go out and talk to a mortgage broker, and then they ultimately close on it, and they sell the property. And then you can repeat the cycle as many times as you want. Okay, so that's an overview of the process. All right, so that's the end of the presentation. If you have any questions, go ahead and contact me. My direct number, 970-225-6989. This has been James Orr. Hope you enjoyed the presentation. Again, contact me if you have any questions. Do my email, jamesorr@gmail.com. Or give me a call, 970-225-6989. Thanks so much and have a great night. Hope you enjoyed the presentation. I sure did. Bye-bye for now.